Hey everybody, welcome to the getting mixed up today. Welcome to the Holy Macro Show. Joined by my co-host Kashop. Got a lot going on today in the markets. Like it's been a busy week. Everybody, it was a crash yesterday. Everybody who was bullish became bearish in one day, and now today everybody's bullish again. It's just, it's funny because the way people always ask me about this on my charts. Why don't I use green arrows much? Like sometimes I do it if I'm like going on a show or trying to illustrate something, but like I don't use greens or reds much on my charts. Reds maybe a little bit more, but I really try to stick to blues, reds, and I use them in opposite ways. Like I'm breakouts, I might highlight red. And the reason why I do that is because it's psychological. It's a psychological thing that sometimes people get extremely like you look at your charts. So if you go into your brokerage account right now, you're going to see they're green. So you see green there and you go, "Okay, cool. I'm bullish. This is great. Everything's great. Everything's perfect." And then you see a red day and you're like, "I got to sell everything. I got to run for the hills. It's the end of the market as we know it." And for me, it's just like you got to stay steadfast in your trades. And so to do that for me, like I like you guys all know, I like to use line charts. I like to look at them once a week. If in the brokerage account, obviously I look at the trades more than that. But in the brokerage account, I'm not looking at that every day. I don't want to know what the positions are doing unless they're hitting a stop loss, unless I hit a sell signal, something like that. And so, my message to everybody just to start out the show is be calm. Trading is there. One day doesn't make a trend or change a trend. And I'm not saying like, whether you're bullish or bearish, that's not my point. My point is to just don't change your mind based on a 1 day position. If the market's red, don't all of a sudden get bearish if you're bullish and you have long positions. And I don't care what you're trading, whether you're in gold miners like Kashop and me, or international stocks, or commodities, or the S&P 500. Doesn't matter. Whatever your positions are, do not just sell out of them because you're feeling a certain way on a certain day. So Kashop, we've been talking a little bit, and we've been talking about a lot of the macro things kind of going on right now, what's going on with the oil markets, the dollar markets, and of course I forgot to share the slides, so give me 1 second, guys. So anyways, Kashop, how are you doing today? I'll get these slides up and we'll get going.
I'm good, thank you. So, when you said there was a crash yesterday, I had to sit up and go recheck my charts to see what the crash was. And I see the S&P is moved a total of 5 points.
It went down during the day and everybody was panicked, and that's what like made me laugh about it, which is like, man, everybody's really losing their mind over this like very small down move in 1 day. And like, yeah, I understand like it can panic people can get upset about things, but it's like, man, if you looked at the entire day, like if you looked at it intraday, sure, if you're sitting there checking it all day long going, "Oh my god, it's this is down 1%, this is down 2%," or whatever you're looking at, yes, you can panic. But if you're sitting there and you're just looking at the end of day price and you're like, "Okay, well, the Dow I think ended the day up, the S&P 500 may have been just about flat." So nothing really happened, and to me that's more indicative of an uptrend, something that's strong in the intermediate term. Now we both have ideas long term on this market, but in the short term, like I'm still bullish on it. There's trends going up. It's not something I would fade by any means. I know a lot of people keep asking me about fading this market, and I'm just like, it's gonna change trend when it changes trend. That's all I can say. So, we got a lot to talk about today. So let's hop into it. So first chart up, I just brought this chart of the dollar index and EFA. So basically, EFA is the all world ETF, or all world index is the EFA, EAFA. I can't even remember anymore. I think it's EAFA. So EFA, when we look at this, and the ETF is EFA, we're basically seeing the correlation with the dollar. And I thought this was a cool chart because it really shows like how correlated this thing is with the dollar. And so you'll see the dollar here's a great example looking at 2020 through 2022. You see 2020 EFA bottoms, the dollar tops, and when IFA really rips was when the dollar rolled over towards the end of the year. I think that was in August, actually. That's interesting. It's kind of around right now where we saw that breakdown in the dollar. We saw bonds break down out of a range as well. Yields started ripping higher, and the all world index, all country index. I'm trying to explain this better to people because I know a lot of people don't look at global stocks. So I'm trying to be very specific here. But when you're looking at this all world index, you're seeing that correlation go the opposite direction. So boom, the dollar starts to go down. You see IFA just trend up, and vice versa when we get to I think that was mid 2021 where the dollar bottomed. So let me highlight that. So this area, the dollar bottomed mid 2021 towards the end of summer. And the next thing you know, the dollar started ripping, put a lot of pressure on stocks. The US was the last to roll over. It rolled over right at the end of the year in 21. And then into 22, we entered a bear market just as the year started. So the bear market started. IFA went down even more. And then if we look at, how strong the dollar was during that period of time, we can see the reason why. And then we see IFA bottom out at the same exact time that the dollar tops. Most of the world did the same thing. If you look at October, even if you go back to my videos on my channel, you can see October 2022. I actually called the bottom. We actually hit a bottom right at that point. IFA started trending, but when did it really take off? And that was recently. In the last year, we've seen this massive move. And part of the thing that got me thinking about this, Kashop, was your tweet talking about China. Nobody wanted to buy China in 2024. Even myself, I remember even saying, like, I have no, and once again, it was breaking down. I'm a trend trader. I'm not gonna, try to jump in. I'm just going, hey, I couldn't see a reason to buy China. And then probably it was, I want to say 6 weeks later, I had to change my mind, and China started hitting 100-day highs, and I started going, hey, I'm going to start buying China here. And everybody thought it was nuts at the time. You were talking about it even before that. So what do you think about China? What do you think about this international trade? I think it's still got legs. A lot of people keep telling me it doesn't, even though I see it ripping every single day. So what are you thinking here?
So if you go back to the last big cycle for international stocks, that was right after the dot-com burst and all the way until the GFC. And that happened during a weak dollar environment. And it wasn't that the United States wasn't growing at that point. It was, I mean, you had the housing bubble. Uh, it was that all the other economies were growing much faster. And that's what gave you that cycle. And that was the Greenspan era, and that was a time where the dollar was getting debased pretty rapidly. I mean, now we look at QE as a permanent feature and we think, oh, this is how financial repression works. But back then, the way financial repression worked was by taking the interest rate below its neutral level and keeping it there for an extended period of time. So when you had the 9/11 attacks, they dropped interest rates, and that kickstarted the next bubble. And it wasn't just a one-time thing with the interest rates; like it was permanently kept low in order to incentivize the housing sector or various other bubbles. So that was a period when you also saw a lot of savings from emerging markets come into the US. And despite all of that, the other markets performed better. And why is that? That's partly because it was their turn. It was their turn to perform. It was the dollar's turn to weaken compared to the other currencies. It was the time for China to integrate more into the world economy, for Brazil to become a big agricultural powerhouse. It was a time for India with its demographic story to shine. It was a time for Poland and all these Eastern European countries, which had aspirations to join the EU. It was that time to open up more. So it was a lot of structural shifts which powered that move in international equities. And if you look at the current period, you do have some kind of structural shifts, but the story is different. So, whether we get a 6-year cycle, 8-year cycle like last time, I don't know. But just looking at the way it started, I think we are going to see a repeat of the 2000 cycle, maybe in a smaller amount of magnitude. I don't know. But in some way, we are going to see it happen.
Yeah, I think that, everybody keeps looking at it in a vacuum. They go all of these they think back to 2000, for example, and they go all of these have to look exactly the same. So, when you see commodities start to slow down, they go, okay, international's dead, this is over. You see the dollar move up for a couple days, they go, the trade's over every single time. And to me, that's really telling of like how this is going to shake out, which is people don't believe in it. And that's great for people like us and anybody else who's out there who's trading this. You have to know that when people just look at it and go, this is dumb, this is stupid. And honestly, like, it's something I talk about a lot with traders, is understanding that fact of when more people hate your trades, the better off it probably is. And it doesn't mean that like you're a genius. It more means the fact that when more people hate your trades, you're in a position that people are betting against. And so when you're in a position that people are betting against, you usually get that negative sentiment. You get more hatred on it. And even if it's in an uptrend and you get negative sentiment, like, that's really good. So for me, I'm looking at this and going, like, Poland's up, what, 70%? I looked at it the other day. It could be down a little bit more, but it was up 70% the other day. And I was just like, this is crazy. Like, the positions we've had all year long have just done so well, but nobody's talking about it. It's still, hey, what are the I still get every other day, what are the Mag 7 gonna, when are they gonna really start to perform? Well, they had a nice jump off of those lows. I think they were up 20-30% on average. But once again, it's like, I don't think that's where the money's going to be made going forward. We have some technology positions in the portfolio, but they're getting smaller and smaller over time. The portfolio's mainly positioned in international stocks and gold miners. Like, think about what I just said about Poland, 70%. What about GDX? 70%. What about GDXJ? 70%. Like, these sector ETFs that are, most people would say can't make a bunch of money in these. They're outperforming the large cap Mag 7 stocks, and
So
nobody wants to buy it.
Greek stocks are up 73% year to date. Who would have imagined that?
Are they? Yeah. So I mean, it's
Yeah.
like you have all of these areas. I've had a couple of people bring that up, and I haven't looked into it much. It is a sector I used to look at more, but like, I just haven't looked at it much. But once again, it's like you have all of this. You have a whole market to trade, right? Like, this is the thing that I think about so much with traders, because it drives me crazy. You have this entire market. There's so many different stocks. There's so many different sectors, ETFs, countries, commodities, currencies, bonds, crypto. Like, you have this huge market, and everybody's a specialist. And there's nothing special about being a specialist as a trader. Like, you want to, like, sometimes, Kashap and I have been around a long time. We're looking at something like Bitcoin. Great. We're going to trade that when it's doing well and it's in an uptrend. We're going to move on to what's next the next time. We're going to be like, Kashap now is mainly in gold miners. Like, I still have a crypto position, but that's not like my major focus. The whole portfolio isn't in Bitcoin. The portfolio is diversified across these things that are doing incredibly well right now. And that's important, which is following the strength, following the next trend, not getting stuck in complacency. I think too many people get stuck in this complacent mode where they feel like they have to just be in this one thing, and this one guy talked about it, and there's this secular trend, or AI is going to take over the world. And the answer is, it's just not like that. That's not how the world works. It's not how trading works. Things change and shift over time. And you and I highlight this all the time. We could go back and, like, you'll hear Kashap and I talk all the time, and he'll say, well, the Nifty 50 stocks in the 50s and 60s, or, we'll talk about 2000, what we just talked about now, and this is what the market did, and so on. When we're talking about that, we're telling people there's different shifts in the market and different cycles that happen. And sometimes you want to be in international stocks, and sometimes you don't. And sometimes you want to be in the Mag 7, and sometimes you don't. But the main thing is being able to move on to what's next. And so, like, for me, looking at this, I really do think, like, this has legs. I'm not saying go buy the EFA ETF. Do not do that. That's not something that I'm recommending. I'm saying go in, find the specific countries you want to be involved in, and the stock, and look at the ETFs and the stocks inside of it, And if you're a stock trader, go in and find the specific stocks you want to trade. But if you're a ETF trader, find the specific countries and buy the ETFs. Or if you're a futures trader, buy the index. However you want to do it, and you're going to make some money. So Kashop, this is my chart that I'm always looking at and always paying attention to for big shifts. And looking at it right now, we're seeing this massive move in the commodity cycle, but commodities haven't really started to lead the way against gold or stocks just yet. But the one thing I'm highlighting here is bonds. Everybody in the world keeps telling me bonds are bottoming right now, and I could be wrong about that. Bonds could bottom, but do I think they're going to make I think a bounce is going to happen. Do I think they're going to make a new high? Do I think they're going to get back to 2020 levels? Do I think that bonds are going to, have some sustainable uptrend? I really don't think so. And I'm wondering your thoughts on, let's talk about the full curve. Short dated bonds, I'm more bullish on. Long dated bonds, and this is looking at the 30 years, I'm not very bullish on. So what are you thinking here, Kashop?
So let's look at what's happening in the market. So the US Treasury is issuing debt and using some of that cash to repurchase its old debt. Now, if the environment is bullish for bonds, why would the Treasury need to repurchase its own debt? It wouldn't. They need to do this right now because they need to control the yield curve. So, what does that tell you? It means that the US Treasury is seeing pressure on the yield curve. And where specifically are they seeing the pressure? They are seeing the pressure on the long end of the curve. So, right there, you have a warning coming from the issuer of the debt saying, hey guys, look, even we are not sure about the prospects of this long term debt. And what are they doing? They are issuing short term debt in order to buy back the long term debt. And the government has been financed using short term debt ever since the Yellen days, that is the previous Treasury Secretary. So you have this going on for a long time where the US is telling you to avoid long bonds. So when you have this strong, powerful signal being sent by the administration, why go against it? There is no incentive to go against it. And now, if you're trading futures, you can get a ton of leverage, capture a counter cyclical move, and say, hey, look, I went long bonds and I made money. And if you remember April 2024, I did make such a call, and it's like, now's the time to go long bonds. And I wrote the trade all the way until September. It was completely contrarian, completely counter cyclical, and I did that. But that trade lasted 4 or 5 months. That's it. It wasn't a trend. It was just trying to find a kind of mean reversion within the trend. The long term trend is bond yields up, bond prices down, avoid the long end of the curve. So I think you should just keep it simple and leave it there. And if you're looking at the short term, yes, there are some good bargains to be had. So if you can find good investment grade credit and get 9%, 10% yields, or you find some good preferred stocks which give you that kind of yield, then yeah, you should absolutely go for it because there is, I don't believe in the 60/40, but I do believe in some kind of a Harry Brown kind of permanent portfolio where you have 25% bonds, 25% gold, real estate, all that. So there is a need to have a fixed income portion in the portfolio. So if you can find particular bonds or particular bond ETFs to fill that function, go for it. But broadly, just taking a view and saying TLT has gone down so much that it's got to be a good buy now. It's a value buy or something like that. Where you just catch falling knives and think you're investing in value. That's really not it. That's not the trade.
No, and I think this is what you just said is a fundamental reason why I think people, when they look at bonds and they see cheap, they think about it like stocks. And even looking at stocks and thinking cheap is obviously most of the time a misconception. But if you look at currencies, like, you think the same thing. Sometimes you think, oh, this is low here and I could buy it, and it's like you're looking at a big fundamental change. Like, you're looking at a big fundamental shift. And let's talk about that fundamental shift in bonds. 2020, we have this blow off top in March. Wild blow off top. in March 2020 that happened that basically started the downtrend. Now, at that time, we were at the end of a 40-year cycle in bonds. And so it wasn't like I'm a genius to say like, hey, that's probably the end of the bond market, but it was, hey, based on cyclicals, based on cycles, based on commodity valuations, based on the fact that the Fed is going to flood the market with cash, we're probably going to be in a situation where we see the bonds just get hammered and inflation come back. And now me and you were both in the same camp on this, but a lot of people were hating that whole idea for a long time. Commodities could never catch a bid again. We were never going to see like inflation ever again. Everything was going to be rainbows and puppy dogs and no quantitative easing. Didn't do anything in 09 to 13 or whatever. I don't know when it stopped because they didn't really disclose that. But at the same time, when we're looking at these things, like, yes, the money didn't go in from 09 forward into commodities. But also there's a million reasons why the way the money was given out, mainly going to the banks and so on, makes a lot more sense because we saw the inflation, but we saw it in stocks. It just went into the market. And so what happened in 2020? What was the big fundamental difference? Well, we gave money to the people. We said, hey, everybody with a pulse, you're going to get, what was it, 5,000 or something. And then you can also get this, you can get unemployment, and we're also going to boost the unemployment. So you got extra money there. And hey, if you have a pulse, you can basically fill out this thing for your business, even if you don't have a business, and we're going to basically give you money. It was for real helicopter money. Like they said that phrase in 09, but it really happened then. So moving forward, now we're here. And, the money's still, like, when you look at the velocity of money and you look at the money out there, there's still liquidity out there. I don't, and once again, it's where's it going to end up is always the question. But now it looks like it's ending up in commodities once again. Like we're seeing it moving into hard assets. We also have a huge need for these hard assets. If we look at copper, if we look at silver, even gold, even the idea of central banks buying gold to their largest amounts ever in history. These are all reasons why this trade has legs. Like, and bonds, I want to stay the hell away from long bonds. Short bonds, sure. Like, I'm sure there'll be trades. And once again, if the trend starts to change in the long bonds, sure, I might even get long the long bonds. But just like Kashop said, I had another trade around that time. It was later than your trade. I think it was a 100-day high in the 10-year bond. Started to buy it. I think it was literally a month later that trade ended and went the other direction very quickly. And I think all the rallies in bonds are going to go that way. I would be so surprised to see a rally in bonds where it doesn't go that way. So, like, I really think that we're going to go right over the cliff. We're probably going to go up and then boom, right over the cliff once again and go lower. And when we really break down this range in the 30-year bond and TLT and so on, like, I think we're headed much lower very quickly. And I think people aren't ready for that trade, which is yields higher. I've been talking about it, which is like the most surprising trade of the year. And this is what the market loves to do to all of us. The most surprising trade right now would be higher yields. And everybody's looking for lower yields. And I'm not saying the short end of the curve can't go lower, but I am saying, look at just last year. We saw that same scenario happen where they started to cut rates, and then the 2-year yield and the 30-year yield and every yield across the board started going higher. So I think it's going to be a something to just to pay attention to and keep watching as we move forward in this market. So Kashop, you wanted to talk about oil a little bit, so let's talk about that.
Sure. So today everyone's talking about oil because there's the Trump Putin summit in Alaska, and everyone thinks that it's bearish for oil prices. So now, regardless of which way the ceasefire talks go, people think it's bearish for oil prices, meaning if there is some kind of ceasefire agreement in Ukraine, then it's bearish for oil because Russian barrels come into the market and that's a boost in supply. And if there is no deal, then, it's going to be harsher sanctions on Russia, and that's it. Like, that's going to lead to collapse in demand in places like India and China. And I think that's a very wrong way of looking at it. So firstly, like, when you look at the chart, it clearly tells you that there is some kind of bottoming process going on, and the the move is asymmetric, meaning any spark that catalyzes higher oil prices is going to feed on itself, and any bad news is kind of mostly priced in. Maybe you get a move lower to 61, 60, and that's it. There it bottoms out because again the value buyers come in. So here's the way I'm thinking about it. I'm thinking about it as there is no way Russia is going to agree to a unilateral ceasefire without some kind of deal from Ukraine coming on the table, which means that the ceasefire news is kind of priced in, it's kind of overpriced in, and traders who are short are going to be in for a surprise. And also, if you look at the long term dynamics, so let's just say there are no more sanctions. Russia's back to being a part of the global economy. And if you remember, just go back a decade, everyone was long Russian equities. It was one of the best performing sectors in the market. I think 2018, 19, that was one of the, I forgot the ticker symbol, but that was one of the best ETFs in the market, paid massive dividends. There's Burbank, whatever, that company paid massive dividends. It was a huge presence in the VC space. So you had this big move, big interest in Russia. Now, let's just say all the sanctions are gone, everything goes back to normal. So what happens on the demand side? China, India, everyone who's been buying Russian barrels at a discount now come onto the world stage and they start buying the regular barrels that are traded in the futures market, which means you have upward pressure from the Indian demand and Chinese demand on your oil futures. Now, there is going to be some kind of demand depression because the kind of demand you have for a $45 barrel of oil is not going to be the same at $60. But the fact that the trade moves from sanctioned barrels to the non-sanctioned barrels means there's going to be a boost to oil prices. And let's just say Russian barrels do return to market. So what is that such a big supply boost? Russia has been under sanctions for so long, and if the sanctions are lifted, they would be quite happy to shut in some production, do all the needed maintenance so that when they come back, they can come back stronger. Because when you have a period where you haven't done maintenance in a long time, that's going to be the more critical factor, not just pumping more and more oil because you just want to get the near term revenue. And especially if the ceasefire deal is in place, then the economy is going to be strong, so you're going to be more long term focused. So I think all these factors, looking at it, it is very very bullish for oil, and the market is misinterpreting it. Now I will leave it to you to analyze this chart, because you and I are talking about it and you had a very good view on it, which I think a lot of people miss.
Yeah, so when we're looking at this, so we're seeing oil still sitting at extremes, smart money buying. So how to dissect this, and I would have made a nicer chart for everybody if I had more time, but we just kind of talked about this last minute, and I wanted to throw this in here because I thought it was an important lesson, which is when you're looking at oil, when people say, hey, the smart money is longer than they've ever been, and you see this chart. So if you look at the middle where the red line is, so I can actually look at this. So where the red line is, that's the commercials. That's what we call the smart money. The blue line, that's the small traders, retails for the most part. And then the green line, that's large speculators. This is your hedge funds and so on. Most of the time, the hedge funds are buying on momentum. So if you see the price going up, they're going to start buying like crazy. See the price going down, they're going to start selling. But why does this, the net position is long on the green line? The net position is short on the smart money line. And why are we saying they're buying at their largest levels? It's because the smart money is always hedging themselves. So they're always hedging themselves against product declines, or sorry, products. So they continue to buy these things as they're at lower prices and sell these things at higher prices over and over again. And that's their job, which is what puts floors into these markets for the most part. So when we're looking at this and we're seeing the floor right here, what we're saying what I'm saying when I say that is that they're buying, and we continue to see every time they're buying to these levels, you'll see a bottom happen. That one created that bounce. Once again, they're buying again here, created that bounce. And now they're buying once again here. And we saw them buying at these levels around the same time that we saw that false breakdown and all that news come out. And once again, this is why I'm always looking at prices, because it front runs everything. So when it's front running things like this and going, okay, well, why are people buying? Why did oil bottom way before that news ever came out? It's because somebody somewhere knows something. I'm not a person talking about manipulation. I'm not a person talking about, how, when markets are manipulated a certain direction and you got rich people over here or the big banks or something. That's not what I'm saying at all. What I'm saying is somebody somewhere knows something at all times. And because of that, you'll see this type of scenario happen from time to time, where you'll see the market start to move before the news ever comes out. They can even sell out into that news and then get right back in at a different level. So I think you're right, Kashab. I do think the oil trade's coming. I'm just not sure when. And the thing to talk about now is copper. So when we're looking at copper, what are you thinking here about copper? I want to hear your opinion first before mine, because I'm wondering, how people are thinking about it, what the fundamental picture really is for copper. That's something that you specialize in more than I do.
So the fundamental picture for copper, ever since electric vehicles came in, it's been mega bullish. And the reason for that is EVs use something like 5 times the amount of copper that a traditional automobile does. So that's a huge source of demand. Plus, you have all the demand around the charging infrastructure. So nowadays, I mean, even in India, even in the small towns, everywhere you go, there is a EV charging outlet. And I mean, here in Dubai, of course, every apartment building has one. Everywhere you go, you have it. And I'm sure in the US, it's no different now that Tesla and GM have done their interconnection. So it's like an even bigger network. So you see this network building out, you see the demand for EVs growing, you see all of this, that puts a huge demand on copper. Now, the recent big move, most of it, people have attributed it to the threat of tariffs. So if Trump imposes tariffs on copper concentrate or copper ore, then that's going to be a problem because US has to import it, and that's going to send copper futures, which is the chart that you see here, higher than the one that you have on the London exchange. So the big dip that you have recently is when Trump said he's going to impose tariffs on copper, but not on the copper concentrate or the ore or the copper cathodes. So when he did that, you saw this big move down 20%. But here's the surprising part. So even after this big move, and my portfolio has copper miners, not copper futures, all the copper stocks are up since this happened. So I have Hudbay, I have Taseko, you have a chart of Hudbay coming later. And so all these companies, they have done better after copper prices crashed than they were doing earlier. So what does that tell you? It tells you this was mostly a positioning flush. A lot of people got caught with too much inventory. And once they realize there is no arbitrage, they are going to get taken out. But long term, this doesn't change anything. And I wouldn't be surprised to see the previous high for copper in the US, the comics price. I wouldn't be surprised to see it getting taken out within a matter of months once this inventory is liquidated, because the long term fundamentals are very, very bullish. And that's also because the demand is growing in the world. So you had a recession in 2022, you had China with its zero COVID, you saw a big clean out of pretty much, I mean, that's what a recession does. It cleans out all the malfunctioning in the economy, the malinvestments in the economy. So once that's happened, you're seeing this growth path. So I think copper is just going to continue to grow based on fundamentals alone. And look, no one's building new copper mines. Even in the US, you talk about building a mine, it's at least 10 years away. Other parts of the world, maybe it's a little quicker, but what we have seen is mines have been shut down. Like in Panama, it's been shut down. You're not seeing new mines getting started at quite the same pace. And there's this company called Northern Dynasty Minerals. So 2016, it was a huge source of speculation. So they have a massive copper project in Alaska, which is near a fishery. So there was huge environmental opposition to it, and people thought, hey, Trump's going to come in, he's going to do wonders for this project, and the stock shot up. And here we are in 2025, another Trump presidency, and that project has gone nowhere. So this is a copper project that has gone nowhere for 25 years in the US, in Alaska, which is a state where the state pays the residents to live there, right? You get mineral royalties in the state passes on mineral royalties to the residents. So everyone's actually incentivized to promote mining there, and it's not happening. And then you have this Resolution Copper project in Arizona. Once again, there is a lot of local opposition, even though Trump said, no, we are going to green light it. So you have all these environmental issues associated with these massive copper mines, and the supply is just not going to be able to keep up with the demand because the permitting is not going to be able to keep up. Like now, Trump says you have this fast permitting process going on, but it's still not enough. And even if the US does it, doesn't mean other countries are going to do it. So long-term supply is just not going to be able to keep up with demand, and there aren't that many new discoveries to satiate this demand. So we are just going to see this chart go up and to the right.
Yeah, I think so too, and the reasons are very similar. You know, when we're looking at price, you look at all of these different miners, and you're seeing the miners, like you said, they're just continuing to rip. They do not care about the copper price. Also, if you look all over the world, and this is the thing, a lot of people who are traders that don't trade futures don't know. There's a lot of different futures markets out there. Their copper doesn't look anything like ours. You know, like the hit that happened didn't happen to them. And once again, the thing to always keep in mind, I always talk about this. I hate news breakouts. Now, once again, it's the least systematic thing that I do is talk about the fact that I hate news breakouts so much, but it's the truth. When I know I'm buying something and it's news related and the breakouts happen on news, every single time that thing usually gets washed away. And it goes back to an old phrase from Bruce Kovner in Market Wizards. So in the first Market Wizards, he talks about the fact that he's, hates buying news-based breakouts. If you find, he says, if you find a breakout that happens and there's no news around it, there's nothing that you can point to that said, hey, this is why the breakout's about to happen. That's the best type of breakout that you're ever going to find. And I completely agree with that. Like, I think that's the truth. Like, look at gold, for example. Greatest, that's one of the best examples of this that I've ever seen. No news on it. Everybody hated it. Everybody was like, this is the end of gold. We're moving into a different cycle and so on. Then gold breaks out in 2024 and nobody cares. Nobody says a word about it. Then it was, I remember it being at like 2,500 and everybody was like, oh my God, it's a bubble. It's the end of it, and it was just like that was ridiculous. But once again, that's the best type of trends that you're ever going to find. The news driven trends, like the breakout that happened in copper, even the breakdown that happened in copper, you have to also think about that too. That was news related. And so I brought a couple of charts just to go through and like look at some of these, Capstone Copper. Sam gave me an actual list because I was like, hey, what copper miners are moving up, but he sent it like right after I made the deck. But like, there's a list of like 5-10 of them that are just continuing to hit new highs over and over again. Capstone Copper hitting new 200-day highs. BVN, this is one, we've been talking about for a while, waiting on this huge, massive base to actually break out for once. There's a million ways to look at it, but just nice smile pattern, rounding bottom, whatever you want to call it. And then we get a nice handle here, and then we break out to the upside. Really good one. Love the way this one looks. Wavy, we are getting to you. Don't worry. Hudbay is next. So Hudbay, same thing. Huge bottoming formation. Next thing you know, we're breaking out to the upside. Another great trade. Like, why do these look totally different than copper? And the reason why is, one, something to think about here. Let's go back. Something to think about here with copper. It is very illiquid. If you look at the futures market for copper, traders like me can trade it. Traders like, one of the big hedge funds or the big banks or any of them, they can't trade it. It's too illiquid for them to get in and out of. So because of that, it's not as illiquid as lumber per se, but it's still pretty illiquid. So when moves happen, they're big moves. They can happen very quickly, up and down. So 10% up days, 20% up days, 20% down days. They happen in this market. They've happened before, they'll happen again. And also something to keep in mind, these things aren't commodities generally are never going to bottom the way people want them to bottom unless it's a liquidity event like 2020. So what I mean by that is when you're looking at this and you're going, oh, I had so many people hit me up and go, hey, should I buy copper here right now? And I'd say give it time. And the reason why I say that is most of the time you don't see these things bottom in a nice way. Look at this one. I mean, it's bottoming, kind of double bottom pattern, bounces, comes back, bottoms once again, and then it moves. Same thing here, you know, a long bottoming formation, Just give it time. And the reason why is commodities tend to have rounding bottoms or, you know, just long-term double bottom patterns, whatever you want to call it. Really, it's just consolidation around those lows. And stocks, they tend to V bottom. And so it's the opposite for commodities. So just get ready to give it some time, see where it goes, and let's see if this thing can go higher. But once again, I'm more still looking at the fact that like I'm going to be bullish on the space until the miners go. It's the same thing. Like everybody knows this. If I say this about Bitcoin, people are inherently they all know this. Bitcoin, if Ethereum is moving up faster. And it doesn't have to be ETH, it's going to change each cycle. It's a new market. So if the altcoins are moving up faster than Bitcoin, what does that mean? Is that bad for crypto? And most people would say, no, of course not. That's risk on, blah, blah, blah. It's the same thing when you look at gold. It's the same thing when you look at copper. Like, what do we keep talking about here in the gold market? Like, everybody keeps writing me and being like, hey, man, it looks like gold is topped. Just like, how would you look at that market and even think that? Because if you're looking at the miners, the precious metal sector as a whole, you're looking at silver miners, you're looking at any of these things, you're going, okay, these are all in a massive uptrend, and gold is chilling out. So why does that matter? Why don't I care about gold? It's because gold has started the move. Gold made the move, started that market. Now gold's consolidating, which means money's trying to find more risk on parts of that market. If gold was just breaking down over and over again and silver wasn't able to catch a bid and the gold miners were crashing, it'd be a different story. But seeing gold consolidate, gold miners go into a nice uptrend, silver miners going in a nice I mean, we're going down the cap scale now. We're seeing even explorers are doing really well. So the gold miners, you see the majors move first, we see the juniors move next. Now we're seeing the explorers moving. Like it just continues to go down this cap scale. And so I think there's just a lot of money to still be made in this copper market. I think now we're kind of seeing that risk on is in this sector. Remember, even the day the copper broke out on all that news, I think it had a 10 or 11% up day that day. I think it hit 16% up at one point. Remember, everybody was like, oh, the copper miners aren't catching a bid. That was true. And so now that they're catching a bid, everybody's going, well, copper's done. No, it's the opposite. Now we're looking at a scenario where now the miners are participating. We're seeing risk on in that sector, and it'll probably keep going. I'd be very surprised if it doesn't. But all of these names are doing well. And so also just wanted to end on this, and then if you had anything you wanted to talk about before we have to go. But the Russell 2000, so Cebu Trade posted this chart. He's always posting great charts. You guys should follow him if you don't. But if we're looking at this chart, you know, we're seeing some real bullish activity in a space that hasn't been very bullish for a very long time, which is the small cap index. Now, this ETF isn't constructed in a way that I really like it. But at the same time, I will say, like, when you look at the futures market and you look at all these things, like there is something kind of going on there. I think it had a massive 30% rally off of those lows. So that was a big move. And we've continued higher after this. Like this is an old chart, but now we're higher. We're all the way up here now. We've also been seeing relative strength in the Russell 2000 over the last 3 months. For me, that's a very bullish development. Do you have any thoughts on small caps in the Kashap?
So I was seeing a chart which was kind of saying the same thing, but in a contrarian way. So BofA puts out these annual the liquidity shifts charts, and I saw a chart which showed a massive shift out of the Russell and into the large caps. And I was looking at the chart of the Russell 2000 versus the Russell 1000, which again showed a massive shift in favor of large caps. But all of that only tells me what this chart is telling me, which is that we're going to see a massive flush in positioning and people are going to rotate out of large caps and into small caps. And that move is coming simply because it's time. So markets trend and markets mean revert. And right now, the large caps have been trending. They have been trending for quite a long time. It's gotten to the point where the top 10 stocks in the S&P 500 now account for 38% of the market cap. Now, the S&P 500 surprisingly is a very concentrated index. So the top 10 always account for something on the order of 20% of the index. And right now it's just gotten to a slightly more ridiculous phase, or kind of to a next level of extreme concentration, which is 38%. So I think as you see that revert to the mean closer to 20, closer to maybe 25, which is the new normal, you're going to see a rotation out of large caps and into small caps. So I think that's what this chart shows, and that's what everyone, I think it makes intuitive sense for it to happen. And I think no one will be surprised to see it happen as well.
Yeah, I agree. I think it's just it's the way the cycles work, right? You know, you see the large caps move. If we just take the cycle and go, okay, 2022, we had a bear market. October, we bottomed. What led the way? Well, large caps led the way. The Dow led the way off the lows at first, which was kind of interesting. Then we kind of diversified more into technology. Just the technology sector, semiconductors. Is when Nvidia had its crazy run. This is when the large cap Mag 7 names had their crazy run. And it makes sense now that we would see a rotation into the small cap space. This ETF isn't the best representation of that. But once again, it's still going to probably see benefits of that cycle. Like you said, money, I mean, it's the same thing we're looking at. So, and this is the big message of the whole thing we're talking about right now, which is money goes from the large cap names because these are the safest. Like if you want to be safe in the markets, like, and if you're a trader, like you really don't care about that. But let's say you're a big fund, you want to be the safest you can be, and you're running, $100 billion. You're probably going to put it into the S&P 500, the SPY ETF, the Qs. What's going to benefit from that the most? The Mag 7. And then over time, money starts to flow out of those areas when those start to slow down and show underperformance. Think of even 2021. The small caps, this huge move that we're looking at here, like that happened from November 2020 through 2021. So that's a huge move, and that was money going out of those areas. And I remember clear as day having conversations with fund managers at that time. So when you look at when I would go out to eat with a fund manager, it was the end of 2021, and they were all talking about how terrible of a year they had. And I was just like, I didn't like go and say like, hey, I had my best year ever. But like I was just confused. Well, what happened? Why did you have a bad year? How did you have a bad year? Well, the market, all my tech stocks underperformed. This happened, so basically my main point is they were all in one area. And if everybody was in the large cap tech names that year, of course you underperformed. Those did terrible in comparison to small caps, or especially commodities. Whatever you wanted to trade, basically, besides large cap technology, had a pretty good year. Financials had a great year. Industrials had a great year. Global stocks had a great year. So if you started to look at it that way, energy had an amazing year. So if you looked at it that way, you were able to make money. But if you kind of stuck with the Mag 7 or the Qs or something, like obviously you underperform. So mainly my main point here is that markets shift, they change. This looks like another change that's incoming. It'd be interesting to see, Jeffrey Hirsch always talks about this as small cap season. When we get into October, he says that small cap season through year end. And most of the time, small caps lead the way during that time. So I wouldn't be surprised to see towards the end of this year, this trade really take off, especially just because of the positioning. The way the positioning is, it kind of just has to move, probably taking the Russell to new all-time highs. And that would be a huge shift and something we just haven't seen in the market yet. We haven't seen the Russell hit new all-time highs since 2021. So I think that'd be a huge shift, a great change in the market, and a new dynamic that we can all trade and make some money from. So, all right, guys, I have to head out. It's great to hang out. Kashyap, as always, great talking to you, man. Do you have anything to end on before we go?
I think we're good. Thanks, Jason.
All right, guys. We'll see you next week, 10 a.m. Eastern time. See you guys later.